Welcome everyone. This is Richard Amoedo, co-founder of Investor Next Door Club. Welcome to tonight's masterclass on why real estate, why it's a pathway to wealth. We're going to be talking a little bit about some of the things that you might know and maybe a lot of things that you don't know. So for some of you who have never ever looked at real estate, or maybe you've looked at it from way far away, I just want you to know tonight's going to be informative for you, and feel free to drop questions, comments in the chat section. I'll address those towards the end. We usually keep these to about 30 minutes. So if we run over a little bit over because we're fielding stuff in the comment section, then just bear with us. So anyway, we're going to dive right in here in just a moment. I'm going to make sure everyone is hopping on here. Let's see. And then I'm going to make sure that my slide deck is ready to go. Okay, we're gonna dive right in. Hopefully you guys came with pen and paper, questions that you might already had, maybe things that pop up along the way. We're gonna cruise through this info on why real estate. But let me give you a little quick background. Backdoored into real estate investing. I started off on the finance side. I was in the mortgage industry 20 some odd years ago. Got out before the crash in 2008. Some of you might be too young to know what that was or experience it. Trust me, your parents remember it very well. And that was just lucky chance that we got out a year or so before that all happened. But I had gotten into asset private lending for real estate investors and had a separate company for that. And that was the first time that I was taking properties back personally through our company, and I had to go in and finish the projects. And because they were in the middle of rehab and they were missing their payments and stuff like that. So there's a lot of foreclosures going on the retail side as well as the investor side. And I discovered that I liked it. And not everyone likes rehabbing. I don't recommend it for everyone. Not everyone likes flipping houses. Again, I don't recommend it for everyone. But given that I had a construction background and I had the finance background, it really was a good marriage. It was a good fit with my experience. So that's how I backdoored into it. Now, prior to being, in the mortgage industry, I mentioned that I was in construction. It was a landscape construction company. We did hardscapes, we did water features, we did stone walls, we did anything you can possibly think of except build a house or actually build a pool. But we did everything else, even laying down driveways and everything. And I share all that because for the longest time, I had that company for 17 years and I thought I was a business owner. Now, some of you have seen this slide that Robert Kiyosaki made very, very famous a long time ago. I didn't see this for the first time until I was 26 years old. And I knew I was an employee because I've always had my own business. But I didn't realize what I was self-employed because I couldn't take time away from the business. He emphasizes a lot the importance of getting into the I quadrant, the investor quadrant, where your money works for you. And he talks a lot about it, but doesn't create a pathway, just plants the seed really, really well, which is almost like painting a dream for somebody in the sky and don't give them a staircase or a ladder how to get to it. But my big aha moment was I wasn't a business owner. I thought I was, but I really wanted to be an investor. The mortgage industry gave me a pathway to that because of my asset lending fund that I had. And that's where I really got the bug for really wanting to dive into real estate more. So for the past 20 years, I've been doing capital raising. I've had two real estate funds, formed a crowd fund, really heavily in the side of mostly raising capital for us, but we have a select amount of clients that we do that for as well. And for those of you that have never done anything with investing or never anything with real estate, I just want you to know that getting into the I quadrant with real estate is one of the fastest pathways to get in that quadrant. It doesn't mean you have to give up your day job. It doesn't mean you have to give up your business. It doesn't mean you have to stop being a contractor, but you want to have one foot in that quadrant sooner than later. So we're going to talk a little bit about what's going on in the market. So, but why real estate? Well, it's built, really a lot of wealth. I mean, 68% of all wealth is held inside of real estate around the world. 90% of all millionaires, they use real estate to grow and protect their wealth because real estate doesn't go to zero. A stock can go to zero. Now, I'm not poo-pooing on the stock market and the ups and downs it's gone through, but we've seen stocks, we've seen crypto, all of that stuff can be really, really volatile. Real estate does ebb and flow, but it's not volatile like the stock market. So it should be an allocation. And the reason why is you've got four main things that happen with real estate, whether it's residential or commercial. Cash flow, monthly income coming from rents. Appreciation, properties tend to go up in value. I'll show you a chart on that in a minute. There's the equity growth. As the debt gets paid down, it increases your equity ownership, which means when you exit, you have a bigger payday. And then there's just tax advantages. There's this tax code book that's, let's say it's this thick. Most people only get to work on about 2 pages of that book if you're not a business owner, and definitely if you're not a real estate investor. So you want to make sure you're taking advantage of all the tax code that you possibly can. And even as a novice, you can as well. Now, we focus on commercial, and here's why. Residential real estate is based on comps. It's driven by the market. Like, your neighbor's house sold for this. They got similar square footage, similar features. It's going to basically mean your house is only going to be able to sell per square foot what similar properties are in your geographic area. So you have no control or no influence on the value for the most part. When it comes to commercial, we're going to do a little math here. It's based on net operating income, NOI. And you're going to hear this a lot, especially if you stick around us. You're going to hear about it. NOI is very, very powerful. And this is something you have full control over because NOI is that net operating income that you get to use. That's your free flowing money, so to speak, right? So bottom line is you have control of that because you can control the expenses. You can control the rent increases or however it is. So you have these dials you can work with. And as that NOI increases, then guess what? Your property is going to be worth more money because it's treated like a business. It's real estate as a business, not a residential property that's just a house, right? Or a single tenant that might be in a property. Now, every dollar you increase in NOI, the property value increases $10 to $20. Well, $10 to $20 doesn't sound like a whole lot. Well, let's do this. Let's say you just increase the NOI by $10,000 a year. You've got a small multifamily. It's 12, 15, 20 units, whatever that might be. And you increase the rents a little bit, and you increase some other features, and they're paying extra for those things. And you manage to increase the NOI by $10,000 without increasing any expenses. Well, that value of that property just went up $100,000 to $200,000. Now, that's on a very conservative basis, okay, because of the way that we did the math here. It could be a lot more than that, and depending on the class of the property, could dramatically impact that as well. Now, some of the terminology when we talk about it, when we talk about NOI, it really is the total income minus the operating expenses. So it doesn't include the mortgage payments and everything. It's really before all those payments happen. So this is what's going to determine how profitable is this, which is going to determine what are buyers willing to pay for that, because that's how they calculate their 3, 5, 10-year returns that they're going to have on that property. So NOI is a really big deal. Well, one of the things that's going on when you look at a 10% cap rate, which is extremely conservative, and understand as an investor, you want to buy at a high cap rate, you want to sell at a low cap rate. That might seem a little backwards, but that's how it works. It's kind of like if you're going in reverse, you turn the opposite way to go the other way. But same thing is here is when you've got that increase in that NOI, that increases, you got a $1 million property, you got a 10% cap rate, you got 100,000 NOI, then you've got 10,000 increase in NOI on top of that. Now your property is worth a minimum of 1.1 million. That's the new value. You can get a loan against that. You could sell it for that. So it's an incredible way to be able to just increase the profitability on commercial. You can't do this with residential. There's some aspects of residential you can do if you have a commercial revenue model inside of that residential property, such as residential assisted living, such as co-living, transitional housing. Those have commercial components and they can go and actually be calculated on NOI. But if you've got a residential house and you've got one tenant living in it, that's just a single family rental, and there's no way you can do that. You're probably barely breaking even when you do that kind of thing, especially in today's markets with the cost of housing. But let's look at this. So real estate doubles in value every 15 years on average. Now, on average means it could happen a lot quicker too, because sometimes it doubles every 7 years. 8 years, 10 years. But pretty much when you look at a 15-year average, real estate is going to double. Depending on how old you are, if you've lived in your house for any period of time or you've lived in a certain area, then you know this to be true. You've seen this happen. This happens with commercial also. And again, playing the NOI formula, you can really impact at even higher, faster than just the market trends will appreciate. And this is going to vary from city to city, market to market, state to state. But, when you're looking at a healthy market that's growing, then you can look at these trajectories. Now, one of the things that's going in the marketplace right now, and this is a long tail that's really dragging this on, is this opportunity has been created, this opening, because people, operators, investors, especially in the commercial space, they got addicted to 3% interest rates. And they played a game, and they played a floating game because that interest rate was barely moving. So there was no reason for them to lock that rate in. And then all of a sudden in 2022, the interest rate started to climb, and everyone thought there's no chance that that is going to keep on growing. Well, it did. Over 12 months, it doubled and went to 7%. By 2023, it was at 7%. Now, picture this, whether this is a mortgage payment or a rental payment, not that this can happen to you as a renter, but just imagine you're paying $2,000 a month for your mortgage. And now all of a sudden it's $4,000 a month, 12 months later. Or you've got a multifamily complex and you've got a $100,000 mortgage payment that you're paying. And now you've got a $200,000 plus mortgage payment. And that happened in less than 12 months. So these operators were not prepared for that. Well, it's continued for the past 3+ years, and this rate has gone as high as 9%. It's dropped down a little bit. Even this year it came down, but it's still in the 6s and 7s, depending on the credit of the borrower. But what this has caused is you've got fully occupied properties that are bleeding out red because they're not profitable. Their NOI is terrible. Their cash flow is terrible, even though the NOI actually still might be good. But they have to sell these properties at a lower cost than what they purchased them at to absorb a new buyer coming in to be profitable because they're going to get a current market rate mortgage. So banks have been extending and pretending, this for quite some time. And right now, you're going to have properties that are just changing hands. This is going to linger for the next couple, 2-3 years at least, because the loans that were done in before 21, they might have done a 3-year or 5-year fixed. Well, they're coming off and they're hitting these high interest rates. So about 50% of all the loans that were done commercially across the country for a number of years are sitting in this type of situation. Warren Buffett said it best. He was at a Berkshire Hathaway meeting and, a lady stood up and had asked, "Hey, Mr. Buffett, what's going to happen with real estate because of all this stuff happening with the interest rates?" And he simply just said very calmly, "Real estate's going to be fine. It's just going to have new owners." And this is one of those things where people took a lot of chances that they didn't need to. They could have had fixed mortgages, but they were pushing the envelope too hard. See, there's a risky way to do real estate investing, and there's a conservative way to do it. And there's no good reason why those operators should be in the situation that they're in, because over 50% of them are doing just fine. And it didn't matter what the interest rates were doing. It doesn't matter what the economy's doing. They are fine because they picked a product that was going to work for them for the long term. They weren't playing a short game. Now, there's a lot of traditional barriers when it comes to real estate for people. One, to get the education, most of the time you're going to see high ticket offers at $10,000 and $30,000 for a 1-year program. Then there's real estate investing where, you're going to have about 25,000 just to get started in a lot of cases. Yes, you could do things with less on residential, but it's a lot of work for very little return. And you're going to flip up your nights and weekends, and you're going to turn your family life completely upside down. And most people don't have the extra income to invest, so they need ways to create additional income before they actually get started. Now, a lot of times, many people feel like it's out of reach, so they feel isolated and totally on their own, and there's not a real solution. That's why Investor Next Door Club was created, was to remove every one of these barriers right here. Now, one of the barriers, and most people don't realize this, is you have to be an accredited investor to invest with certain operators. Well, actually, with all operators, especially if they're doing commercial or any kind of fund or anything like that. So, what does that mean? Well, accredited investor means you've got an over at least a million net worth, and it doesn't include your primary residence, so you can't count that equity of your home. Or you've got an income greater of 200,000, or combined with your partner or spouse at 300,000 a year. Now, that's less than 13% of the population, and that number's actually gone down a little bit over the recent 12 months, but this is the stat that the SEC has posted. So bottom line is most people can't access what high net worth people can access. And that's one of the barriers that we really remove here at Investor Next Door Club. Now, some of the things that we focus on when it comes to residential, we take a commercial approach with co-living or transitional housing. There's a lot of variations of this, but the reason why we're heavily focused on this is because the market opportunity is growing tremendously. People are needing better alternatives for affordable housing. They want to be in a house, but they don't want to be able to afford the whole house, so they're renting rooms. And this is not what you might think it is. This is a very classy type setup with this, and they don't want to look at spending 2,000 a month or 1,500 on an apartment when they could be spending 8 or 900 a month and save that money over 12 and 24 months and get themselves in a better position. And there's so many different classes of people that are doing this now. This was big overseas, a lot in Europe. And it's made it over here to the States over the past 10 years. And one of the things that's made it a lot easier is just the software to manage all of this, because America was not prepared for this. But what it allows people to do is cut their overhead dramatically and gives them a community too. And so it's just been a great, profitable way. When I say most real estate investors, 98% of them don't even know what this is or don't even understand it. So this is something that is a trend over the next 10 years that's going to really be booming. The other one that's really booming is senior living. And you've got 10,000 baby boomers that are turning 65 every day. And a lot of them don't want to go into a facility, so they look at co-living, they look at residential assisted living. But when they are ready for a senior or some type of assisted living or even memory care, then they look at these types of facilities. And really, over the next 20 or so years, we're seeing an incredible trend with this. And part of the reason why is because during this thing called COVID, construction dramatically halted. And we don't have enough labor in construction anymore. Matter of fact, the head count is about 20 to 30%, depending on the area, but is less. But yet the demand is still high. So the supply is staying really, really low. So we've just got this bottleneck that's happening that's causing this to be a very, very high demand sector. And, at some point in time, when people do enter these independent or assisted living or memory care facilities, it's more of a progression of that they're moving into these different types of care. As an investor, you can be passive in these, and you don't have to be accredited to do it. Now, most programs you do, but we're going to talk a little bit about why we take away that barrier. So, how many of you believe that being in the right room with the right people can completely change your financial future? Most people at this point would agree. Mary and I have had experienced our greatest transformation personally, financially, even spiritually by being in communities that were locking arms and helping everybody win. And because when you gain awareness and you're around people that are fighting for your best, you are going to grow faster than you ever could alone. Now, I know a lot of people who say, well, I just want to be my own cowboy, my own show. And that's fine, but it is harder to do things that way. I've done things with partners. I've done things with groups, investment clubs over the years. And that has always allowed us to take advantage of projects and opportunities that I couldn't have done on my own. Or if I could have, again, I would have completely disrupted my lifestyle and flipped my family, the quality of life that we have, upside down. So there's real power when it comes to community. We like having get-togethers in person. We do things virtually online as well because we like to scale. As we continue to grow, we'll be setting up chapters in different cities. We're already in multiple states now, but this has been an exciting time for a lot of people, even real estate agents who are around real estate all the time. They never invest. Now they have opportunities to invest alongside their clients or their peers. Now, investment clubs are a unique animal. It's been around for over 100 years. Different than my previous funds, but what it allows for is it creates real opportunities. It gives people real voting power because they have real fractional ownership. It is the best of both worlds. It's the perfect blend of, the power of active ownership with the simplicity of passive investing. And this is something that high net worth people have been doing a long time. And one of the reasons why I did not participate or promote investment clubs was because there wasn't the software to manage these things. It's tedious. And along with my other funds, we didn't have to worry about some of the compliance that investment clubs do. But our members get access to investment clubs, which allow them to get into things that they couldn't do on their own. I think Helen Keller says it best: alone we can do so little, but together we can do so much. And that has been my experience in real estate investing. That's been my experience in business or building sales and marketing teams. It is really critical that you're with the right people at the right time, especially in times like these where people are feeling squeezed and a lot of pressure to get ahead, but it almost feels like quicksand or running up a hill in a mudslide. It's not a lot of fun. But our members, get access to participate in opportunities like this that they couldn't do on their own, whether it's multifamily, assisted living, storage facilities, flex space, data centers, as well as RV parks and so much more, because most people aren't in a position to take on one of these by themselves. And also, these opportunities are typically reserved for that 13% class of people because they have to be accredited to get involved as a limited partner. Well, you could actually be a fractional owner in properties like this if you're doing it through investment clubs. Now, so we do what no one else does. If you're not ready, we put you on a path to be ready. And we show people lots of ways of how they cut their expenses, how they cut their taxes, how they cut their debt up, even create additional income before it's even time for them to start investing. You have to get prepared. I think most people would agree that if you decided in 6 months or 12 months you wanted to run a marathon and you haven't been running a lick right now, you need time to get prepared. Well, you need to be able to do it in a way that's not stressful and that is not going to put a ridiculous amount of demand on your financial ability. You need to be able to move that trend upward towards yourself. And the way you do it is by creating new knowledge, new awareness, new peers, and new opportunities. Now, if there was a proven system that helps everyday people own real estate, regardless of personal income, would you want to learn more about that? Most of the people that we talk to say yes, because everything they've seen so far prior to meeting us has been way out of reach. Whether it was the high ticket program, whether it was, the high minimum to get into. See, my peers that are fund managers, they have a minimum of $25,000 to get involved with them. Most of them are actually 50 to 100,000. So they're looking for a very select class of people. We created Investor Next Door because we wanted the next door, the neighbor, to be able to get involved without risking a fortune, without paying a lot of money for high education, and being able to do it in a way that works for them in a passive way. So I want to dive in real quick just to see if there's any questions or any comments here. Let me close this out. There we go. And you really can ask anything. It's really an open book here. Let's see. I got a question here. It says, for someone to determine whether or not they are an accredited investor, are they allowed to include the funds that may exist in the retirement accounts? The answer is yes. Now, you may not be able to use those funds if they're locked up, depending on who your custodian is. But if you have stuff in a self-directed IRA, then you could use that. If you have certain solo 401ks that allow you to direct that money outside of the custodian's products, then the answer is yes. But yes, you get to count that. You just can't count your equity in your primary residence. You could count it in secondary property. You just can't count it in your primary residence. There's a lot of things about the SEC I do think they get right, but there's some things I think they really get wrong. You can be 18 years old and you can play the lottery if your state has a law that allows that. So you can play that game of chance. If you're, in a state that allows casinos, if you're 21, I think it is in most cases, maybe Louisiana's 18, I can't remember. But I think Vegas is 21. Whatever it is, you can go play those games of chances. But God forbid you're 22 years old, you've been responsible financially, and you've got, 10, 15, $20,000 to invest in a commercial project. You can't. That operator will not be able to take your money. That was one of the most frustrating things for me when I had my two funds is people would ask me two questions all the time. They would say, "Can you teach me?" And I'd say no. I didn't have the bandwidth, I didn't have a system for it. We were running our business, running our funds. There was no way. And then the next they would say, "Well, since you're too busy and you can't do it, can I invest with you?" And I would have to say no because they weren't accredited. And when we came back from Japan, we really looked at what we were going to do inside of real estate. And I knew that I wanted to crack the code for the everyday person to have access to what all my clients and other investors were able to have access to for decades. And it's like, how do we do that? And that's when we really did the hard work on investment clubs of how do we allow everyday people to become owners, not passive investors, give them real access, real ownership, real returns, things that they can access the tax code with and start building their future, net worth, their nest egg, whatever that might be. See, if you don't own assets, it's really hard to leave a legacy. You can leave a lot of things, but if your goal is to leave something behind, well, it's going to have to probably come from hard assets. If your goal is to make sure you're set up for retirement well, and you want to have enough cash flow coming in that's beyond your 401k, that's beyond Social Security, and no one's relying on Social Security these days, then you're going to want to have income coming in from properties that you own or you fractionally own. And we find that a lot of people, have over the years, they dream about owning real estate. They dream about it because they don't think they can access it. And the other thing is, if they've gone to look, they've gotten disappointed because they're hit up for some high ticket deal. And I've participated, Mary and I probably invested well over $100,000 in various courses over the years, and we've gotten value, but I wouldn't recommend it for a new person. And it's just not it's not conducive for someone getting started in most cases. They usually end up putting it on a credit card. They usually take out a loan of some sort, or they finance it with the company, and it's double digit interest, and they start off with a burden. And we didn't want people to experience that. We wanted people to have an on ramp to get started where they are and get on that journey. And for some of our members, that's 3 months, 6 months, a year. It just depends on where you are. But you can't wait to get in shape. And it's kind of like, you want to get more fit. And you decide, I don't want to get a gym membership until I'm in better shape. That math doesn't usually work, right? You think about all the people you've maybe done it, maybe you know people who have done it. You just get the gym membership and you start showing up. It's the same thing here. And that's what we teach our members in our community. And everyone's going to move at their own pace. And there's no judgment here. This is a no judgment zone. This is where you get prepared, and then this is where you grow and scale. And we're practicing and teaching everything that we've done over the past couple of decades. So I appreciate you guys being on tonight's session. We're happy to be on the journey with you, and we look forward to growing with you. Have a great night for now. Bye bye.